When it comes to managing your money, two terms often come up: saving and investing. Both are important, but which one should you focus on? In this video, we're going to break down the key differences between saving and investing, when each should be a priority, and how you can use both to reach your financial goals. Let's dive in. What is saving? Saving is the act of setting aside money for future use, typically in a safe and accessible way. It's all about building an emergency fund, covering upcoming expenses, and ensuring that you have cash when you need it most. Saving doesn't involve much risk, and while the returns may be low, your money is safe and available when you need it. Example: let's say you want to buy a new phone. You decide to save up for it over the next few months. You put aside a portion of your income each week into a savings account, and in a few months, you have enough money to buy the phone without going into debt. This is the power of saving. It helps you reach smaller, more immediate financial goals. The goal of saving is security. You want to make sure that you have money available for things like unexpected car repairs, medical bills, or any other emergencies that might pop up. Saving gives you peace of mind because you know that you have a cushion to fall back on. What is investing? Investing, on the other hand, is the act of using your money to buy assets that have the potential to grow in value over time. Unlike saving, investing carries some risk because the value of your investments can go up or down. However, over the long term, investing has the potential to help you build wealth far more effectively than saving alone. Example: let's say you have a small amount of money, say $500. Instead of letting it sit in a savings account where it earns a tiny amount of interest, you decide to invest it in stocks. Over time, the value of your stocks may grow, and you may end up with more than $500, especially if the stock market does well. However, if the market dips, your $500 might lose some value. This illustrates the potential upside and risk of investing. But remember, investing isn't a get-rich-quick strategy. It's about making your money work for you over time, understanding that there will be ups and downs along the way. The key to successful investing is patience and consistency. Over the long term, investments like stocks or real estate have historically outperformed savings accounts in terms of growth. The key differences between saving and investing. 1. Risk and return. Saving is low risk, and the return is typically small. You're not going to get rich from saving, but you also won't lose your money. It's a safe place to store money for short-term needs or emergencies. Investing involves higher risk, but it also offers the potential for greater returns. The value of your investment can grow, but it can also decrease. The key is to know your risk tolerance and time horizon. 2. Purpose. Saving is meant for short-term goals and emergencies. It's your safety net. You use savings for things like buying a car, going on vacation, or covering medical expenses. Investing is aimed at long-term wealth building. You invest for the future to help you reach financial milestones like retirement, buying a house, or even funding a child's education. The goal of investing is to outpace inflation and grow your wealth over time. 3. Accessibility. Savings are typically easy to access. You can withdraw money from a savings account at any time without penalties, except if you're using a high-interest account. The goal of savings is liquidity, being able to access your money quickly if needed. Investments are less accessible. You can sell stocks or bonds, but it might take time, and the value could fluctuate before you get your money back. Investments should be viewed as long-term assets. When should you save? It's important to save when you need immediate access to your money or when you're building an emergency fund. Experts recommend saving at least 3 to 6 months' worth of living expenses. That way, if an unexpected event happens, like losing your job or facing an unexpected expense, you have enough money to cover it. Here's a simple example. Imagine you're saving for a vacation that's coming up in 6 months. You would put aside money regularly in a savings account so that when it's time to go, you have enough to cover the costs. You wouldn't want to invest this money as you may need it soon, and investing carries some risk. Moreover, having an emergency fund in place is one of the best things you can do for your financial health. It gives you the freedom to take risks and pursue long-term financial goals because you know you have a safety net for unexpected situations. When should you invest? Investing should be a priority when you're thinking about long-term goals, such as retirement, buying a home, or growing your wealth over time. If you have money that you don't need to access for at least 5 years or more, then investing could be the way to go. Example: let's say you're in your early 30s and you want to retire at 65. You start investing $200 per month into a retirement fund. Over the years, your investments will grow, potentially making you much more than your initial contribution due to compound interest. The earlier you start investing, the more time your money has to grow. Investing is about leveraging time. The longer you invest, the more likely you are to see significant returns, thanks to the power of compound growth. But remember, investing isn't without risk, so you should only invest money that you won't need for a long time and ensure that your investments align with your risk tolerance. Balancing saving and investing. Should you focus only on saving or only on investing? The answer is neither. You need a balance of both. Start with saving. Make sure you have a solid emergency fund and money for short-term goals. Once that's in place, start investing for your future. The key is to prioritize saving for emergencies while also investing to build wealth over the long term. For example, if your total income is $3,000 and your expenses are $2,000, you have $1,000 left. You could allocate 60% of this remaining amount, $600, towards savings, and 40%, $400, towards investments. As you get more comfortable with your finances, you can adjust these portions based on your goals and risk tolerance. Common misconceptions about saving and investing. 1. Saving is enough. Some people believe that saving alone will get them to their financial goals. While saving is essential, it's unlikely to grow your wealth significantly enough to achieve long-term goals, like retirement, without investing. Saving can provide security, but investing provides the potential for real growth. 2. Investing is too risky. Yes, investing carries risk, but it also has the potential for growth. Over time, risk can be managed by diversifying your investments and staying patient. The longer you invest, the less the risk will matter in the long run. Remember, if you avoid investing because of risk, you miss out on potential wealth-building opportunities. Finding the right strategy for you. In the end, both saving and investing are important. You don't have to choose one over the other. Saving ensures that you have security and liquidity, while investing allows you to grow your wealth over time. By balancing both, you can manage your short-term needs and build a financially secure future. Now that you understand the difference between saving and investing, take action today. Start by setting up an emergency fund if you haven't already, and consider speaking with a financial advisor about how to begin investing. Remember, it's never too early to start planning for your future. If you found this video helpful, don't forget to like, share, and subscribe for more personal finance tips. Leave a comment below with your thoughts on saving and investing. What's your strategy?